Hello, everyone. My name is Inam, and I am one of the newest members of KW Commercial Atlanta Perimeter team. I attended our early December session where we talked about the new federal opportunity zones. The topic was intriguing for me, so I decided to research a bit to understand it better. So I ended up speaking with the IRS, the Department of Treasury, a couple of companies that have come out with funds to address this opportunity, a friend of mine who teaches at a fancy school in Boston and knows the subject well, and one legal firm that is advising the businesses on these matters. This presentation is a summary of my findings, and I hope you will find this useful too. Of course, I'm not an expert on this topic and request all to read the disclaimer at the bottom of this chart before proceeding further. I'm assuming that we all have some basic knowledge and understanding of the topic, hence, won't share the background and reasoning behind the program. Okay, a total of 8,700 new federal opportunity zones have been created covering all 50 states, Washington, D.C., and 5 U.S. territories. Puerto Rico being a little unique, that 100% area of Puerto Rico has been declared as the opportunity zone. Out of these 8,700 federal zones in the country, 260 are in Georgia. In the past, I think about 17, 18 years ago, state of Georgia also created some opportunity zones, a total of 100 state level zones offering their own state level tax incentives. They are totally different than these new federal zones, and in most cases, they do not overlap. I'm working on a map where I will try to show where they do overlap in Georgia and how combined benefits can be enjoyed by the investors. Okay, the characteristics of these zones. The federal government gave a target of 32% poverty rate and having a job loss of at least 6% from 2011 to 2015 as the guide to all the states and territories to identify their own zones. Average national household income turned out to be $59,000 per year, covering about 35 million people in the country, currently residing in these federally identified zones. In some cases, like Louisiana, for example, the average income has around was around $36,000 per household. Although in New York, the average household income turned out to be in these zones $98,000. Actually, the new Amazon facility that's going into New York, it is also in one of those qualified federal opportunity zones, and apparently the average household income in that given area of New York is above $105,000. Okay, the basics of the program offering. Investors can bring their capital gain from any kind of investment and not just from the real estate. So, stocks, bonds, jewelry, art, cryptocurrency, or any other type of capital gain can be invested into this new program. Secondly, a person cannot take his capital gain and invest in these zones directly, like Joe Smith buying a property in a qualified zone is not allowed. All investment must go into a corporation or a partnership, also known as Opportunity Zone Fund, that is either recently created for the purpose of investing in these zones or an existing corporation or partnership that modifies its charter and bylaws to reflect their new focus being primarily these opportunity zones. However, a person can be the sole owner of an LLC, and through this LLC, he or she can become an investor into this program. Lastly, these funds can be invested in these zones either in real estate or any qualified business. These new funds cannot invest any capital and get the benefit into these 8 listed businesses. As you can see, I'm not going to read all. However, restaurants and bars that offer alcohol on their own premises for consumption are okay and qualified. It's just the liquor stores that are not allowed. Besides these 8 listed businesses, every other legal business is qualified. This is also an important chart to understand that the funds can be used for three purposes only: either to construct a new real estate facility, or starting a new business, or buying an existing real estate facility or business, provided they substantially improve existing real estate or the business they are buying. So, how do we define the substantial improvement? There is a lot of incorrect information floating around on the internet about this topic. So, this is how it goes. First of all, substantial improvement comes into play when you're buying existing real estate facility that is already constructed or buying a running business. So, let's look at this example first, being buying an existing real estate facility. Purchase price of the building, say $1 million, land value 400K. So the net real estate value turns out to be $600,000. So additional investment under the heading of substantial improvement needed is 50% of the net value, which is $300,000. In the case of buying an existing business, it's simpler. Purchase price of the business, say $1 million. Substantial improvement funds needed, $500,000. Now, how much time do we have to improve the property or business? 30 months. Now, 30 months also applies to a project where one buys land and construct a new facility. There are three other conditions that we should understand well. Number one, the minimum 50% sales of business or real estate has to be generated from the zone itself. This has been the most critiqued condition of this plan. The way the policy is written at the moment and released in October of 2018, a business selling items online where more than 50% of its sales will come from other parts of the country outside the zone is not qualified. It is expected that this policy will change when the new details are supposed to emerge in March of 2019. Number two, 90% of the funds invested has to be in the zones. Basically, that means that the funds are allowed to invest 10% of the amount collected wherever they want to invest, outside the zones. Actually, there's a way to bring down that percentage to 70%, and I'll be glad to share that method separately if you have any interest. Lastly, there is no external certification required for establishing such a fund or investing into a qualified investment. It's actually a self-certification process that each fund will have to self-certify with each tax filing, and a new form called Form 8996 has been created by the IRS for this purpose. All right, the zones in our own area. This is not a complete map of Georgia, but only expanded metro Atlanta area. As we can see, some parts of Norcross, Marietta, Smyrna, Ackworth, and Atlanta are also included in it. The new Amazon facility that is going in New York is actually included in a zone. I mentioned that earlier. These zones are not bad zones. I mean, they are very close to very active, commercially active areas, and that's how they have been selected by each state. Okay, the federal capital gain tax benefits. What are the actual benefits? Majority of the experts out there actually believe that the plan has been created in such a way that non-real estate investors, meaning people having capital gains in other areas such as stocks and bonds and all that, it's actually planned for them to bring their money into real estate, which is actually good for people like you and me. And it appears to be the case so far. There are three things that we really need to understand in terms of the benefits. Number one is that the tax gain deferral is for up to 7 years. Okay, so that's number one, and we'll talk a little bit more about that. There is a partial forgiveness of the capital gain amount to be taxed up to 15%, and we'll talk about that a little bit too. And then forgiveness of additional gains completely, and that's for additional gains for the investment that we are going to make into these zones, not for the investments that we bring into these zones. Okay, we'll talk about all that in a minute. This is probably the most important information that we all should understand, I guess. Similar to 1031 exchange plan, investors have 180 days after capital gain realization to invest into these funds. If investors want their money out before 5 years, they pay tax on 100% of the amount they brought in. But if they take their money out after 5 years but before 7 years, they get 10% capital gain reduction for tax purposes. But if they leave the money for up to 7 years, they get 15% gain reduction for tax purposes. So this is the maximum any investors can enjoy when he or she brings capital gain into these opportunity zones, meaning 15%. There is a key date here, December 31st, 2026. This is the date when all such funds will have to pay capital gain taxes on the amounts they brought into the program. So to get maximum benefit of 15% reduction, one must invest no later than end of 2019. However, any new, and I repeat the word new, or you may want to call incremental capital gain investors will experience is completely tax-free if they keep the original funds into these zones for at least 10 years. So if I invest $1 million into these funds and that investment becomes $2 million after 10 years and I cash out, the capital gain I will realize that additional $1 million will be completely tax-free. Here is an example of a fund that was invested, say, in early 2019 or even 2018 and enjoyed 15% tax benefit in 7 years, but kept the money in the same fund for 10 years. Comparing to a standard IRR of 6%, it performed actually 51% better. Not a bad deal. I mentioned this earlier that investing into this fund early is the whole idea. So investing early has significant benefits. As you can see, the incentives perish with delayed investment. Here is another example. This assumes a standard return of 10% per annum. As you can see, your traditional investment will yield a total of 68% after 10 years, but opportunity zones can give you a return of 139%. Again, this is not a comparison with 1031 exchange, but a standard investment since vast majority of funds are expected to come to this project from non-real estate related capital gains. Okay, how much money is out there that can be funneled into these programs? Um, as per all the research articles that I have seen, a total of 6.3 trillion dollars worth of capital gain is out there that is not realized yet. A conservative estimate is that at least 2% of this amount will get transferred into these opportunity zones, out of which at least 80% will be real estate based investments. So we are looking into at an investment of about $100 billion, $101 billion, and at least half of it by 2019 in real estate. Population wise, Georgia is 3% of the country. So if we get at least that much from this total investment, we can probably expect about $3 billion worth of investment into our state in the next 18 months or so. There are many questions out there, and I'm sure I don't have all of them here, but these are my basic four questions that I'm not clear about. And you may have come up with your own questions too. As I mentioned earlier, 50% local activity is an issue at the moment. All of my contacts believe that this requirement will be relaxed in March. My other question is that, okay, a fund that takes money and construct a new strip mall, can they lease a shop to a business that is currently classified as unqualified? Like if I have a strip mall, can I have a massage parlor rented out to someone um, or not? Third question I have um, is depreciation, bonus depreciation allowed or not? So in the case of when buying an existing real estate that has, for example, a factory equipment, will I be able to bonus depreciate all the equipment in the first year so that I can decrease the net value of my net real estate so that the substantial improvement fund requirement becomes lower? Is that allowed or not? That's not clear at the moment. And lastly, what tax year will be used for tax rate purposes? We are investing money into these funds now, and earliest we take the money out, let's say 5 years, and benefit 10% of waiver. The tax that will be applied on the 90%, will it be the tax rate of capital gain tax rate of that time or today? That is currently not stated in the policy. All that is supposed to come out in March of 2019. The very last chart, what's next? How do we benefit as realtors? What are the real opportunities for us? What tools are out there? There are some states, some cities in the states that are very active in helping out realtors in providing data and access to information and stuff like that. Basically, how can we be on the forefront line of this? This is basically the ongoing research, the next, and I'm continuing with that. If you'd like me to share what I find, shoot me an email or text. I will send you my next presentation. You can call it episode 2 if you want. I don't know when, but I will continue to do research. If I get information or answers earlier than March from the Department of Treasury or IRS, then I will definitely issue earlier. Let's see how it transpires, and then I'm continuing research in terms of real estate side, the realtors benefit side, and what can we do to benefit, and that may be available earlier. So shoot me an email or text or call. I'll put you on the list, and my numbers and the email address is right here, and we'll go from there. Thanks a lot for your time.